Thank you for joining us on Transfer Pricing 201. We will begin momentarily, so please hold on. Welcome to Transfer Pricing University, Transfer Pricing 201, session number 4, comparable selection. Let's get started. So here's a brief agenda of what we're going to talk about today. So when it comes to selecting comparables, we're going to talk a little bit more, we'll give you a little bit of the background context. Then we'll talk about the fact that comparables don't exist, which is kind of a bold statement, but we'll go into the details there. And then we will talk a little bit about the data we can rely on, the challenges of using certain databases and the availability of data. We'll go through a little more in-depthly evaluating comparability requirements. And then we'll have some suggestions at the end in terms of improving the process of preparing benchmarking analyses, and then finally our conclusion, which will hopefully highlight the main takeaways after this session. With that, let's get started. So from a background perspective, let's talk about the methods and the applicable benchmarks, because all of the different prescribed methods for transfer pricing purposes, it requires some form of benchmarking or comparability analysis to occur. So if you recall from the earlier Transfer Pricing University sessions, the 5 prescribed methods are really the CUP method, or otherwise known as the CUT method, as well as in the US IRS regulations. And what that really is a direct price comparison, right? So CUP method takes the unit price for product A and compares it to the unit price for product B, or in an ideal situation, it'd be for the same product. The resale price method evaluates or compares the gross margin on sales. And really, you're looking at the resale price of goods purchased from related parties versus a distributor who might be reselling the same goods purchased from an unrelated party, or vice versa. And then a cost plus method is basically looking at the other side of the transaction. So if we simplified it once again and thought about it in the context of a tangible goods transaction, it really is looking at the manufacturer side of that transaction. What are the direct associated with manufacturing that good, and what return I'm getting on my costs? Looking at it on a growth level, because I know that there could be some confusion in terms of cost plus method versus the cost plus markup, but that's for another session. And then finally, I think the last two methods are profit-based economic analyses approaches, which are probably the more commonplace methods that people rely upon for their transfer pricing documentation. And so the CPM, which is the comparable profits method, as prescribed by the IRS and also the Taiwanese transfer pricing regulations, versus the transactional net margin method, which is the OECD of profit-based economic analysis approach. What that does is it looks at the operating profit level, and it looks at various financial ratios or indicators on an operating profitability basis. And then the profit split method is really to assessing the division of the appropriate profit. But as you can see, all of these different methods require some form of benchmarking in order to apply it correctly and to assess the arm's length nature of that transaction. But even before we determine what the method is, in order to determine the appropriate method to apply to any particular intercompany transaction, the functional analysis is crucial, right? So we had, I think it was session number 2, where we talked about the functions, assets, and risks, and understanding, talking a little bit about how to perform functional analyses and why it's so important. But really the functional analysis, once again, to reiterate, it's getting an understanding of the contractual terms, the understanding the key functions, assets, and risks. And all of this is really important because the outcome of the functional analysis is really what drives the comparable evaluation process. So if you have the wrong functional analysis in place and you're not describing the operations correctly, then your search for comparables may be tainted, right? And what I mean by they could be tainted, just to give you an example of that is, let's say the functional analysis or the transaction is the sale of a tangible good between two affiliates. And the one affiliate, you think, okay, well, they're distributing the goods. So the functional analysis, is basically structured to say that, okay, well, one entity performs all different functions, bears risks associated with distribution operations. The other entity bears all sorts of functions, risks, and holds assets associated with manufacturing activities. But that there's valuable processes in place and valuable IP associated with the actual manufacturing know-how associated with the product that's being manufactured or developed. So if that's the case, who owns the manufacturing? The distributor owns it. It's interesting because once I say that the distributor owns it, I wonder, which side of that transaction becomes, or which entity involved in that transaction is the less complex entity? Is it the manufacturer or is it the distributor? Could it also be that the manufacturer is manufacturing on behalf of that entity that's actually distributing the goods? Yes. So functional analysis ultimately drive your comparable search to say, I should look at distributors. Well, it could if you just look at it on the surface, but then if you miss that key element analysis to say, well, the distributor the manufacturing know-how and IP associated with manufacturing processes, well then, should it really be that you want to look for distribution, or do you want to look for contract manufacturing comparables to actually test the other side of the transaction, right? So that's one way where the functional analysis is really important for purposes of driving the selection of comparable companies. It could be that maybe the selection of the tested party wasn't appropriate or something to that effect. I had mentioned this in last week's session that a clear example or clear case study related to that was Bausch & Lomb. So Bausch & Lomb, where it was the U.S. owned all the proprietary technology or intellectual property associated with the manufacturing of contact lenses, and there were some questions about whether or not the purchase of contact lenses should be benchmarked using a contract manufacturing return versus a distribution return. And I think we talked about that last time. But that was a very key element to the overall case to determine the appropriate characterization of the transaction. So the other piece that we want to also talk about a little bit in terms of background, right, is that your choice of the best and most appropriate method also depends on the data, the availability of data. So a couple of questions to first think through. Whether or not internal uncontrolled transactions exist. So if you're talking about a tangible goods transaction, which is always the easiest way to think about it, it's, are you selling the same product to your related parties and to unrelated parties based on similar market terms and conditions and similar levels of market? And if the answer is yes, well, then maybe you have an appropriate cup to apply and you have that direct price comparison available. You could also, and the difference between a cup method versus a cost plus could be the product comparability. I think that's the easiest way to think about it. So the example I always give is manufacture red pens and blue pens, but for some reason the per unit price of a red pen is twice as much as a blue pen because the cost of red ink is that much more expensive. Well, then you can't do a direct price. The products are they're similar, but they're not exactly the same. And in that, the cost plus method or the resale price method might be more appropriate because ultimately the products are similar enough. The underlying cost structure is different, significantly different, where a cup doesn't apply, but the cost plus or resale price could. Right? But once again, a cup or a cost plus can only be applied to the extent that those transactions exist. So if they don't, which do not exist, because typically as a multinational or as an organization, I would say, you don't sell the exact same products at the same level of market to their parties to do the exact same thing that your related party is doing, because then you're creating competition, right? For your own related party. So why would you want to do that to your related party themselves? So you don't see a lot of those transactions in the marketplace. Now, then do external uncontrolled transactions exist? So then we go and rely on third-party databases to say, well, are there actual observable market transactions? Are there license agreements that are similar enough or comparable enough in order to benchmark the royalty rate that's being similar arrangement? So usually you'll see external uncontrolled transactions. So we apply that sort of approach when we're looking at royalties being paid for the licensing of intellectual property. We also apply that sort of approach when we're doing loan analyses, because we are able to identify third-party loan transactions and or financial transactions with a sufficient level of comparability, such as bond transactions or certain bonds, right? So similar characteristics to intercompany loans. So those are some of the ways where you might be able to identify unit pricing. The other area where unit pricing might be about this or commodity transactions, where there is a very liquid and deep market of actual transactions between two unrelated parties for the sale of various commodities. And so under that situation, it could be that you could use those market observations. Talk about that a little bit more in-depthly in a second. And then external untraditional transactions, if you're looking to apply sort of a gross margin analysis versus an operating profit analysis, what you would be looking to do is identify third-party companies comparable to the entity for whom you've selected as the tested party, right? So, in a lot of ways, I think the bottom line is that your method will depend on the reliability of data. And so the most appropriate method is very dependent on data. All right, so let's talk about the fact that comparables don't exist. And I hear this from some prospects sometimes to say, well, comparables don't exist. What do I do? Well, there still needs to be some form of benchmarking that occurs, right? So once again, cup data is actually rarely available, except for commodities, right? So, and except for certain transactions for licensing agreements, we will be able to find third-party licensing agreements. We are also able to find loan benchmarks. But let's talk about commodity pricing a little bit, because on the surface, commodity pricing, it looks like a cup, but it's a quoted price. And so one of the things that we hear companies rely on would be, oh, well, we got third-party quotes and therefore we charge based on that basis. Well, the problem with quotes is that they're not actually observed market transactions. So that's usually why you can't necessarily rely on quotation. But because commodities markets are usually much more liquid and even though we're not able to actually identify the details of the underlying transactions, many countries have adopted the applicability of, commodity market pricing as an appropriate way to assess the arm's length nature of these sorts of transactions. And so it is now sort of, I guess some people might consider it a sixth method. I do consider it as part of a cup, is the same as a cup analysis, because it is sufficiently sort of situation where the transactions have a sufficient level of comparability, right? Commodity is commodity most of the time, as long as it's not being transformed into something else. And then once again, commodity sort of pricing is applicable and recommended to be applicable when the market is liquid enough to be able to support the fact that this pricing is readily available and based on market terms and conditions. Okay. So, but I think going back to the fact, the statement here that comparables don't exist, it's because no two companies are actually alike. So moving on beyond the potential availability of cups, it's are we actually able to identify exactly the same type of licensing arrangement between two unrelated parties? Well, we can find these arrangements with a sufficient level of comparability, but it's never perfect, right? Because products are always different. I mean, companies are can be in similar industries and in similar lines of business and have competing products, and that makes sense, but the underlying products are never exactly the same. And so I think it's important to note that there are always decisions that are being made by the person performing any sort of benchmarking analysis to assess what sort of comparability requirements are most important for purposes of that the application of that method. And so it's just, are you making the best decisions based on the guidance that each of the different countries are to taxpayers? And we'll go through sort of the suggestions in the latter half of the presentation here. The third bullet I have here about formulary apportionment, it's still a question mark. Countries like Brazil have this approach to take a much more formulary, if I think to say it's a very selfish way in some ways to think about the transfer pricing returns, where Brazil says, well, if you're importing transactions, then you need to achieve a resale margin of 20 prescribed margin of return. And the problem with formulary apportionment is really that it's going to be extremely difficult to get that level of international cooperation in order to minimize the impact to the taxpayer from a double taxation issue, or else really it could result in a lot of double taxation on a global basis. So formulary apportionment is so far not on the table, which is good news, I think, all around. Then we talk about profit-based economic analyses. And remember, this is where we're really looking at the functions, not the specific transactions, but we're looking at trying to identify third-party companies that are engaged in the same type of functions that we're trying to, and assume a similar level of risk and a similar level of assets. And I think that it is extremely rare to find a perfect comparable. I've done comp searches for over 15 years, and I can tell you there are very, very few times where we could say that is a perfect comparable. There's always something that you can find that would be slightly different in terms of what the return would be for that particular business activity. Even on the surface, if you think about the qualitative narrative, that business description could indicate that the company engages in the types of functions that you want to benchmark, but there could be factors such as the size of the company that could impact the returns or the comparability of that company. But once again, I think that the standard we're trying to get to for any analysis is reasonably reliable comparables. And this is the language as prescribed by the OECD and various transfer pricing rules and regulations. It's all about reasonably reliable comparables. And if the search process actually has integrity without bias, it's all about emphasizing that you have a reasonable outcome, right, within the boundaries of what is actually practical. So remember, you're never going to come to a set and have a set of perfect comparables that no one is necessarily going to challenge, but you want to be armed with an understanding of why selected for purposes of this analysis makes these comparables reasonably reliable. There was where I've spoken to various practitioners, and some practitioners actually take the position of you don't accept comparables, you actually reject non-comparables, so which is I think in a lot of ways true, because it's very hard to identify good, perfect comparables. And so in some ways, what you're doing is you're taking a very principled approach to being able to whittle down the set of potentially comparable companies into something that makes sense, and along those, throughout that process, what you're doing is you're rejecting non-comparables based on the various comparability requirements that you're trying to assess. And through that process, remember, the transfer pricing analysis really should indicate a commercially relevant. So I think sometimes you might come to a set of results and it gives you an answer and the tested party falls within the range and that's it, or the tested party falls out of range and you just say, well, you're going to have to make some changes to the pricing. That may not necessarily always be the case. I think that that's a little short-sighted. It's really important to understand that the pricing structure has to be commercially rational. And so it could be that on the sale of this tangible good, that the pricing does make sense, and maybe the entity is losing money because they just have a ridiculous overhead structure that doesn't make sense, and given where they stand, and therefore there's certain labor laws where they can't wind down the operations, and that all of that I think needs to be thought through before just haphazardly making an adjustment to then shore up the expenses of that distributor to give them a distribution margin that falls in line with the arm's length results. Right? So remember, everything has to make sense. Okay. And I think that going back to one of my earlier points is that comparables, even though comparables are not going to be perfect, and everyone might have a different perspective in terms of the selection of comparables and which ones would be deemed the most relevant and most appropriate, but that all kind of goes back to the interpretation of the functional analysis, right? So I spoke about this just a second ago on one of the other slides, but really about making sure that the functional analysis clearly articulates the types of functions that should be benchmarked. So, and therefore, these types of comparables are the types of companies that we want to use for benchmarking purposes, because we're looking at functions A, B, C, and that's what my functional analysis outlines. So a lot of times the challenges about the selection of comparables really kind of, it stems from this misinterpretation of the functions, risks, and the assets in some ways, or the tax authority's position to say that this comparable is not comparable because of ABC. Well, that's because in a position that says your functional analysis says that your entity, your tested party does not perform functions ABC, and therefore this comparable is not comparable, right? So once again, it's always important to go back to understanding exactly what your functional analysis is saying about the intercompany transaction and about the characterization of the tested party in order to make sure that the types of comparable companies selected are in fact reasonably reliable comparables. Okay, so with that being said, let's talk a little bit about databases, because the bottom line here is that everyone, tax authorities, taxpayers alike, face the same challenges when it comes to databases. Number one, databases are expensive. They are very expensive, and tax authorities themselves don't have a sufficient amount of funds a lot of times to actually buy these databases in order to perform their own search. So they have limited accessibility. Countries like Romania, they will license databases and they use the funds from their APA application process in order to license databases. And other countries, Kenya is one example, where Kenya licenses databases only to the extent that they can actually collect TP adjustments, or it's based on their projected forecast of potential TP adjustments, which is a little bit scary, right? That they can only afford to buy databases to assess the arm's length nature of intercompany transactions based on the adjustments that they can identify. So clearly this need to be able to identify TP even in countries like Kenya. So everyone's starting from a similar playing field, right? And so the same issues, once you get access to data, becomes a problem in terms of, well, what type of information is available? Is there a certain level of data standardization? Are there actually comparables available in my particular geographic region? A lot of countries have been stating that they have a strong preference for local comparables. And that's important to note, because from an audit perspective and from a due diligence perspective, you should absolutely look for potentially comparable companies using geographic market as one comparability requirement. The question I think a lot of people might have is, should that be one of the more stricter forms of comparability, or and then in order to be able to identify companies operating particularly in the same country or region, then you have to loosen your comparability requirements in other areas. For example, maybe you're going to loosen comparability requirements where in terms of product comparability, right? Because when you're looking for comparable companies, the product comparability is not as important from a profit-based economic analysis as functional comparability is, and therefore, do you want to be able to broaden the search parameters to expand beyond the product grouping or the industry grouping, perhaps, in order to identify companies that are actually operating in that particular country? And those are the decisions you have to make. And so I think that this table here, though, gives really good perspective in terms of ability of actual records of companies operating in a particular country. So the way that you read this table here is that there are 106 different countries who basically have less than 10 potential. And keeping in mind that this basically means potentially comparable is the universe of potentially comparable companies. This is not even saying potentially comparable distributors or potentially comparable contract manufacturers. So we're not even talking about functional comparability at this point. We're merely talking about the availability of records with financial data. And there's over 106 different countries that have less than 10 potentially comparable companies. And so, starting with that universe, we know that there is less likely going to be a reliable set of comparables on a country-by-country basis. So many countries are going to loosen that restriction and say, well, regional, you can expand to accept companies that are operating in perhaps the same sub-region or the same region. And so this table, though, just so that everyone gets a sense of the background, it's coming from this group of bodies, the Platform for Collaboration on Tax, which is basically made up of the OECD, the IMF, the International Monetary Fund, the United Nations, and the World Bank Group. And they had basically surveyed or asked information from private database providers to understand exactly how many data records are available. So this is where these statistics come from, and published in 2016. So maybe a little bit outdated, but still I think it's directionally correct. A country like the US, just so that everyone gets a sense of where that falls into, actually falls within the 20 countries with 10,000 to 100,000 records. So the US does not fall into the greatest category in terms of the number of available records. And I think that is because in the US, there's no requirement for private companies to actually share financial data. And so that comes to the question of how many of those records are privately held public companies. And there has been more and more talk about, the use of private company data and the reliability of private company data. I think that there needs to be perhaps some more questionability of private company data, because the public company data is monitored, and there are certain rules in place in terms of the level of detail that needs to be provided for public company data. But for private company data, there are less rules and restrictions in terms of how data is recorded and when it's recorded and things of that nature. And so there's no need to audit private company data, at least or have those audited financial statements available, right? And so whether or not that data can be relied upon is always a question. And so I think that the bottom line, though, here is that data is not easy to come by in every jurisdiction. So once again, you have to make decisions about what type of data or what type of comparability requirements you want to be the most strict about. I've also put a little statement here about the use of secret comparables. And this was probably more of a problem many, many years ago. I think nowadays, most countries have taken a position in terms of the use of secret comparables to basically say, we don't advise it. And the secret comparable data, where does it come from? Well, it probably came from the fact that most tax agencies have data available by virtue of their tax filings, the taxes that are filed. And so most countries now have issued statements or put into the regulatory guidance that secret comparables are no longer going to be utilized, which is good news for most taxpayers, because then we're talking about a playing field that's not the same, right? So no more secret comparables. So here I've listed out the typical search process, right? And I think this is important to note because, how do you perform a comparable company search? Well, first you look at industry business activity qualification codes. So in a lot of times we're looking at SIC codes, NACE codes, hedge codes that could be applied depending on different databases, right? So you first start with the universe of companies, and then you apply certain codes to identify potentially comparable companies. Then you might restrict it based on geographic market, the region, to that set of potentially comparable companies. Then you might apply keywords and screen based on financial. I'd also want to further whittle down that set of companies by the number of employees, level of revenues, based on the size of the company. 6 would be based on independence, because companies who have majority owners or shareholders, their financial data may not be representative of true market pricing because they could have their own transfer pricing related issues. And on the other side of that, it could be that a company with unconsolidated results and many subsidiaries could also face the same transfer pricing related issues, because if it's unconsolidated, then intercompany transactions are not eliminated. The other comparability requirement could be based on financial accounts. It could be type of financial accounts, excuse me. It could be based on entities. And then finally, last but not least, is the qualitative screening for functional comparability. So is this very objective way to narrow down the set of potentially comparable companies. And then 9 is that final step, that qualitative review. Let's look at the business description. Let's see what they say. And then let's do our due diligence to make sure that, in fact, what those business description in the database is of the functions being performed in a particular type of company. But can you imagine when you apply 1 through, your universe of comparables could easily go down to a non-manageable size. So based on criteria 2, the geography or market region. So once again, if we were restricting that to any of those 106 countries from the slide, well, with records of observations, then slide screen 1 and 2, we may be left with nothing to actually review qualitatively. So the two requirements highlighted in red, I think, are potential areas. I think maybe the first two areas of where you may want to be able to loosen your restriction requirements, your comparability restrictions, in order to be able to identify a reasonable set of comparable companies. So a little bit more in depth later. What I'd like to note is that OECD has so much good information, and so they had interviewed various country representatives sometime in 2016, and based on those interviews, some countries basically have provided some guidance to say, like countries like South Africa, Mexico, New Zealand, Norway, and Colombia. A few examples of countries where if they were to audit you as a taxpayer, they have basically taken the position that they would start by looking at your list of comparable companies, and then provide their recommendation if they were to disagree or agree with them. And that's an important note because is what Australia does. So our understanding currently is that Australia, they won't even look at your benchmark, the search process, and they'll clearly look at your functional analysis. But then Australia licenses data undertake their own benchmarking analysis in order to come to determine what an arm's length range could be. So I think that it's important to just get an understanding of maybe what that tax authority's position would be related to benchmark comparability. I think it is very telling that Australia places more emphasis on potentially comparable companies, which is why we know one of those countries that has historically been in a position to say that they prefer country-specific comparables. And clearly in Australia and or New Zealand or in similar geographic markets, it does restrict the potential pool of comparable companies. And so, as more and more comparable searches or benchmarking analyses are performed, there's a limited number of companies. So unless databases enhance the availability of private company data, I think that you will see, even for countries like Australia, where sometimes you have to make certain decisions to expand the comparability requirement beyond the Australian market. It could also be that certain places will promote sub-regional approaches as opposed to regional. So an example where maybe a sub-regional approach could be promoted is for the Nordic countries, Sweden, Finland, Norway. So I think that in that case, it's understood that those markets are a lot more comparable, and therefore limiting it to that sub-region of Europe maybe to approach the comparability analysis. And then other countries have actually taken interesting. China, for example, we know China would like to actually see country-specific comparables. But China wants to see country-specific comparables for public company data. And perspective from them as a member of the OECD to say they would prefer pan-Asian private company data. So that's an interesting development because they want China comps if you can find them based on publicly available data. But if you are going to move beyond the private company data realm, then there is a preference to expand to Pan-Asian private company data. So once again, I think the question is, in some ways, whether or not comparability requirement 2 and or maybe even 6, independence, that perhaps those are some areas where, as a taxpayer, you may want to consider, loosening your restriction requirements in those two particular areas as opposed to some of the other comparability factors. But those are decisions that you have to make through the process of trying to identify the best set of comparable companies. Because remember, everything is a facts and circumstances based exercise. So if you're in a particular industry where the regional or market comparability is perhaps one of the biggest drivers of profitability for your organization, then that becomes a much more important comparability criteria to keep, as opposed to maybe the size of the organization doesn't matter, but usually size is generally going to be applicable based on economies of scale. Or product comparability. Maybe product comparability really doesn't matter because, a widget is a widget is a widget, right? So perhaps that could be the case. So it really is a facts and circumstances based exercise. So here finally we get into I think the meat of this transfer pricing university session, which is, what can I do to improve my benchmarking? Things that I might be able to do, get better comparables, or to improve the reliability of the existing comparables, right? So a couple of things to think about. Whether or not you're looking at, more diagnostic financial ratios, right? So perhaps, and this goes beyond just applying financial ratios as an objective measure to whittle down your set of potentially comparable companies. Because in practice, most practitioners will use diagnostic financial ratios in order to take the universe of potentially comparable companies and narrow them down to a more focused set of comparables. So, for example, the R&D to sales ratio is more readily applied in practice because we know we want to look for routine distributors. We know that routine distributors would not engage in significant levels of R&D. And therefore, if an objective approach and get rid of companies who have a significant level of R&D in comparison to their sales, then we know that our starting point is already on a much better basis than if we were to take the entire universe of just companies classified under this sort of industry code, right? So, and it could be that maybe that's the way you even want to start your search, right? Because the typical search process today, yes, it does outline these steps to say this is usually the way that we approach the search. But in some ways, I think if you're having a hard time identifying potentially comparable companies, does it then make sense to start with a broader universe and narrow down that universe of comparables based on more diagnostic financial ratios, right? So that's a way to potentially think about improving the underlying benchmarking analyses that you're doing today. It's not a conventional approach, and it definitely is not, may be challenged, but at the same time, I think it could it give you more reliable results? It could. And the other thing to keep in mind is maybe you also want to look at multiple profit level indicators. And I think that this is interesting because you don't like the set of comparable companies that you have because you think that maybe they're functionally they're not that comparable, or they don't have the same product, or they're not operating in the same industry, but perhaps they're the best you can get. After you look at looking at the different financial ratios, number one, to say, well, fine, qualitatively they're not comparable, but if you look at these financial ratios, maybe there's something to say about quantitatively as a business, you can make the argument that they're comparable. But you can also look at multiple PLIs to assess different PLIs depending on that you're benchmarking. So then it becomes really important to understand which profit level indicator, PLI, you choose for purposes of this analysis. And looking at could also be a way to assess potential comparability as well, right? So it could be very telling in a lot of ways. The other couple ways to think about this is if you really don't have any comps, well then maybe you take a more fragmented approach. And if that's what the OECD calls it, or the platform on tax collaboration, I should say, they call it a build-up approach. And the idea is perhaps you're looking for wholesale distributors who are also engaged in installation services, and you can't find good comparables that are just distributors and with installation services. And this is perhaps a classic example of where you might want to think of building up the appropriate PLI, because what you could do is you could look for wholesale distributors in a similar industry. Then you can look for just companies that are engaged in sort of installation or technical service activities, and perhaps you want to consolidate those returns, right? And perhaps that's based on you weight the distribution activity 75% versus 25% because you know that 75% of your sales is driven by the actual sale versus 25% is driven by your installation activities. So there's a way to also fragment out the different components or activities that are being performed in order to build up a better range to truly benchmark the arm's length nature of the intercompany transaction, or really the tested party in a lot of ways. And then one of the things I like to remind myself a lot is don't forget about alternatives available to the parties, because at the end of the day, what else are these companies going to do if they don't enter into this transaction? What else would they do? And if you start thinking about what their options are outside of the intercompany transaction, it could provide some perspective in terms of what type of benchmark could be reliable for purposes of this analysis, or where else might you look? So it's really interesting when you start asking that question, what you might in terms of a creative solution when you don't have good comparables. Of course, we've talked about in your comparability requirements, right? Maybe geographic region is definitely one of those areas I think you have to sort of loosen in a lot of ways because of the lack of comparable company data. And then the last suggestion is interesting because we've taken both approaches for different companies. And what this is what if you have multiple sets of comparables, meaning a more restrictive smaller set and perhaps a less restrictive sort of large sample comparable companies, right? So there have been economists over the past couple of years that have issued sort of their perspective on, what is an appropriate rate of return for distribution activities. And there have been opinions on it where a distributor is a distributor, and they make anywhere from 3 to 5%, and I think that's a generally accepted rule of thumb, so to speak. So it could be that maybe the approach is maybe you want to have two sets to say, hey, here's our universe of comparables without qualitative review, but here's how we got there. It's a principled approach, once again, to look at the 9 various comparability factors, and to look at these financial diagnostic ratios, and this is what we came up with. Forget about the quality of the comparables, but look at our sample size. Our sample size is very large. It's large enough to eliminate the noise associated with the outliers. And so that could be one range. And then the second range could be, well, when we looked at it in more detail, this is the set of comparables that we came up with that we believe are sufficiently reasonably comparable to our tested party. And maybe and perhaps you look at the overlapping range to say, and to say, well, this should be deemed a reasonably reliable arm's length range based on the facts and circumstances. So there are companies that have taken both approaches to comp searches. And there are companies, very large companies, that have taken that more broad-based sort of statistical position on comparable searches to say we have 1,000 accepted comparables and here's our range, and you know, we think it's reliable, versus companies, versus benchmarking activities where we have comparable sets of maybe 4 or 5 companies, because these are really good comparable companies, and therefore we really don't think you can get rid of any of them. So clearly, when you only have 4 or 5 companies, you're going to have a lot of sensitivity if you get challenged on any selection of them, versus a very large set, you're not going to have a lot of sensitivity to removing 1 or 2 comps from the set. So pros and cons to both sides. Maybe looking at both sides makes a lot of sense based on your facts and circumstances, but it's just another way to think about potentially identifying or potentially analyzing your intercompany transaction, right? And it's been observed both ways. The other type of way to also improve benchmarking analyses or the set of comparable companies is adjustments. So what kind of adjustments can I apply? And then we've talked about this in Transfer Pricing 101, working capital adjustments. The typical working capital apply would be to make the comparable company's level of inventory, payables, receivables, or PP&E similar and lined up to the tested parties. And really the challenges here are just about, okay, well, are you applying the right rate of interest, right? You know, is the balance sheet actually reflective of the level of inventory, payables, and receivables actually, you know, achieved or utilized by that particular company? Because remember, balance sheet items are just a point in time, and therefore, because it's just a point in time, you know, is it really reflective of what that working capital level is of that company over the year? The way that we usually avoid that is we do look at balance sheet. When we do apply working capital adjustments, we look at the average balance sheet item over the current year and the prior year, and that helps alleviate some of the concern about the fact that balance sheet is just a point in time, but it doesn't alleviate all of the concerns about that particular issue. It's interesting because working capital adjustments, there's a little bit of a paradox, because tax authorities have basically said that, you know, if you apply working capital adjustments, that, you know, these types of adjustments will not materially alter the results of their arm's length range. But if you apply working capital adjustments and there are large adjustments, well, they think that it could cause concern that that company is not actually comparable. So it's a little bit of a paradox there. Then some countries also don't really like working capital adjustments, and they would prefer to rely on more of the qualitative analysis rather than the quantitative. So South Africa and more notably Australia would be in that boat, so where they really want to look at the qualitative versus, you know, looking at adjustments to further enhance the reliability of the comparables. And then the other piece, the working capital adjustments, remember, can also be applied sort of as a proxy for a functional adjustment. So, for example, if you are looking at a limited risk distributor that doesn't take inventory, you know, or doesn't hold any inventory, for example, do you want to then reduce the level of inventory the comparable companies, the level of inventory down to 0, so that they have 0 working capital? So that's a way to potentially improve the reliability of the benchmark. But once again, countries like Australia would really prefer not to see working capital adjustments. And then adjustments for accounting differences. These are just notable in that different companies might have timing adjustments related to inventory write-offs, or perhaps their depreciation methods are different over a different useful life or expected life of that particular asset. There could also be permanent differences, how a company recognizes its revenue versus how it recognizes its expenses. And then there could be classification differences. One company A might recognize certain costs as part of their cost versus, company B might recognize those same costs under operating expenses. And so I think that despite the use of international accounting standards such as IFRS, there are still accounting differences between industries. So it's important to just understand what those potential differences could be that could impact the reliability of the comparables. And then finally, last but not least, country risk adjustments. So the fact that our tested party is in a more risky country, perhaps there needs to be a premium or a discount applied to the results to account for the riskiness associated with operating in country or jurisdiction. So there are different ways that a country risk is applied. One way might be to take the comparables, working capital levels, and down to zero using the interest rate of their particular country. And basically taking their working capital levels and bringing it up to the tested party's levels of working capital using the interest rate of the tested party. So if you do that and you look at the difference between the zero adjusted results and the new results, then that difference could potentially be attributable to the country. It could be assigned be the value to assign as a country risk adjustment. So it's important to consider potential country risk adjustments, especially in a country like South Africa, for example, where transfer pricing issues are prevalent. They want to see that the selection of comparable companies is based on countries with similar risk profiles, but otherwise country risk adjustments are actually and they want to see that. All right, we are coming up to almost to the full hour here, and I think that this slide is more so about providing some useful information. Safe harbors. So some countries have published what they consider safe harbors, and take this with a grain of salt because I only put in a few ranges here, but there are very specific rules about when these safe harbors are applicable. And a couple of things to keep in mind is that the OECD and the EU JDPF are not countries, so those safe harbors are prescribed from a guidance perspective. In order for them to be actually applicable to a particular country, like an OECD country, they have to be adopted into law, so just keep that in mind. So countries like Australia have a safe harbor of 7.5% on certain services. So once again, it's really applicable to based on very particular facts and circumstances that safe harbors are applicable. But safe harbors have been issued by these countries to help alleviate some of the compliance-related burden costs. But I don't really know if it achieves that really holistically, because at the end of the day, some of these margins may or may not be appropriate from your business organization perspective. And so if that's from a business organization perspective, then you probably want to take to actually do an appropriate level of benchmark what a reasonable return or an arm's length return should be for those particular functions, because these may have been put into place. These safe harbors may have been put into place at a time when they were relevant, but they may not be relevant anymore. All right, so the conclusion basically here is that perfect comps don't exist. No matter how many times we look for perfect comparables, they just don't exist. Even a company like Tech Data, which is in almost all computer software or computer hardware distribution sets, in some ways, I know that there are companies that don't like including them in the set because they're such a large, a very large organization with a huge amount of revenues, and it just doesn't, because they have such economies of scale and such a large global presence overall, even though from a functional perspective, some companies are like, well, that's not comparable to the activities that we perform because of the scale of the operation. So once again, perfect comps don't. But the selection of selecting comparables requires a significant level of judgment. And so hopefully the tools that we've discussed within this presentation allow you to make good judgment calls for purposes of producing a robust set of comparables. And remember, the various factors that should be considered are always based on the facts and circumstance. Goes back to the functional analysis. In some ways, I think that, the functional analysis is more important than the benchmarking. Actually, I think in a lot of ways it's more important than the benchmarking, because if your functional analysis is not right, well, your benchmarking is going to be all wrong. So just make sure that you pay close attention to the functional analysis. And then adjustments aren't always appropriate, and may not always be possible either. So adjustments should not be haphazardly applied. I think they need to be considered based on the facts and circumstances. And the last but not least, the most important point, I think, is that, remember, tax authorities have the same challenges that you do as a taxpayer. And everyone is trying to achieve a result that is favorable to them in a lot of ways based on the arm's length principle, which unfortunately and fortunately, I think, it's not a precise science. It's not an exact science that says this is the answer, this is the end-all be-all answer. It is open to your interpretation based on the facts and circumstances of your organization. But understanding that the tax authorities have the same challenges, I think, hopefully will give you the appropriate level of perspective to be able to get to a reasonable set of comparables with a sufficient level of support so that you can support your position. So with that being said, if you do have any questions or concerns, please feel free to email us or call us. We're happy to address your questions, and we look forward to seeing you at future transfer pricing universities. We appreciate your time, and thank you for listening to us.